Welcome to Living Your Greatness. Each episode, we bring on great people to inspire you to achieve your greatness. We discuss topics all related to health and wellness. Listen to world-class stories, learn valuable lessons, and turn knowledge into action. It is now time for you to unlock your inner greatness. Welcome back, everyone, to another episode of Living Your Greatness. This is your host, Ben Mummy. Today, I'm excited to bring back a previous guest, and his name is Peter Krauth. So for those of you who don't know Peter, he is a former portfolio advisor and 20-year veteran of the resource market with special expertise in precious metals, mining, and energy stocks. He is currently an editor at Resource Maven of two newsletters to help investors profit from the metal market opportunities, and they are called the Silver Stock Investor and the Gold Resource Investor. So Peter, it is a pleasure to have you back on the show.
I'm thrilled and excited. Thanks so much, Ben. Happy to be back and chatting with you.
Same here, Peter. I am super excited to have you back on the show, and as well as celebrate, your new exciting success, which was publishing The Great Silver Bull. And I will also want to congratulate you before we even hop in, because last week that it became an Amazon bestseller, right?
Yes, that's right. In Canada, it's a number one bestseller in the commodities category. So I'm really happy about that, and hoping that to keep up that momentum.
It must be such a rewarding process, right? Because you've seen this book go from nothing to all of a sudden something, and I'm sure along the way too, there was people that helped you at some point as well to support your kind of goal and kind of vision of coming to life, right?
Absolutely. I mean, I have to say that you're right. You doubt yourself a fair bit at the beginning, and had really we chatted about this just before starting the interview. But I had worked a fair bit through the book, actually about 50% of it, before I actually started telling anybody. I mean, anybody very close knew perhaps, but anybody of other significance didn't know. And it's amazing how that unlocked a bunch of things for me. People started saying, well, hey, I can help you. I've got some background. I can read it for you if you need. So-and-so has all this expertise in helping bring authors, to market, so to speak. I knew people who could help with editing. And so it really kind of came together for me. And like I say, it's a collaborative effort, and I'm very fortunate and grateful, really, that the way it kind of happened, and that everyone contributed to help to make this a success.
That's awesome, Peter. Again, I'm so happy for you, and again, congratulations. Peter, I actually want to move to your book and kind of just start simply with the subtitle, Crush Inflation and Profit as the Dollar Dies. So from what I understand, you're obviously trying to help investors understand that. Something that I am curious about is, before this book came to life, what sparked your motivation to even write this book?
Well, as you know, one of my newsletters is focused on silver, and silver is a very particular kind of investment, I guess, option and opportunity. And I think that from all of my research and experience, I've seen that silver can do tremendous things to help people grow their portfolio, and it remains an incredible not just opportunity but value at this point. And I felt that the newsletter was perhaps not the easiest or best tool to bring all the ideas around silver in one place to investors or potential investors, and that the book could be that to take, I guess, all of my knowledge, and certainly a bunch of learned knowledge as I did the research, because there were plenty of things I learned as well as I went through it, into one place, that I could really present the entire idea to people about what silver could do and why it made sense, and actually I feel really is a necessary part of everyone's portfolio, even if it's a small part.
Awesome. And actually a key word that I think you had said just now was, you actually said opportunity, right? That this is an opportunity. And I know in your book, you actually say, silver is a generational opportunity. And you've kind of supported that by saying, silver is going to be in the largest bull market that we've ever experienced, bigger than even like the 1970s. So a question that I'm curious about is, what makes you have such strong convictions that silver will be the trade of the decade?
Okay, well, yes, I think what you mentioned, the 70s is important to look at because it was the last, my view really, it was the last sort of full cycle secular silver bull market. And from about 1971 to 1980, silver was up 3,700%. It outpaced gold by more than doubling gold's returns. Gold was up about 1,400%, which is nothing to turn your nose at, but that was more than double what gold produced. And it wasn't without volatility. There was a period in the middle of the 70s where silver went from, I believe it was, about $6 down to about $4. Again, this is just roughly if memory serves me right, but it was as close to 50% down, and it was drawn out as well. It lasted a fair bit, and then it took off again. And then in the second half of that bull market, it absolutely exploded in the last sort of year or so. And I guess you'd say a large portion of the returns came in the back end of that bull market. And so that's one of the peculiarities of silver, is that you don't really ever know when it's going to take off, but you don't want to not be participating because that could kind of happen at any time. And so there are ways to build an investment portfolio in silver to mitigate some risk, but to have exposure to it, to be ready for when that time does come. And the 70s were crazy. 3,700% is fantastic in a decade. By the way, in a decade when stocks were completely flat, the Dow and the S&P, before accounting for inflation, returned zero. So to make 3,700% with some volatility versus zero after waiting 10 years is pretty good. And what also distinguishes the 70s from now, I think, is that in the 70s, in the US, for example, the debt to GDP ratio in the US was about 35%. So the debt was only 35% of the country's annual economic output. Today, the debt in the US is about 130% of the country's economic output. And so the country is much, much more indebted. The inflation that we've been experiencing for the past year and a half, that really has people waking up and concerned, rightly so, is going to be a lot more difficult to get under control. It was tough enough in the 70s, but I think this time it's a totally different game. And that makes something like silver, that performed extremely well in the 70s, even more important and likely to do as well or better.
Absolutely. And I think you brought on a lot of good points, of why this is such a huge generational opportunity. And I think it was key too, that you pointed out that it's better to be the first person in the room or trying to be early in the game rather than later in the game, right? Especially because silver is such a tiny market and it can really explode, right? It's very volatile, right? It could really go up and it could really come down. But before we continue on this discussion, just for like the benefit of my listeners, I know in your first part of your book, you talked about a brief history of silver, right? You kind of write about the great reasons silver, but not gold, became the first truly international currency. So what are the unique properties of silver that make it an ideal form of money?
Okay, so there are many. And in fact, it's interesting because it goes back to, I really like actually that historical connection. It goes back to Aristotle in Greece, who, thousands of years ago said gold was the ideal form of money. In fact, silver was also, and there were 5 properties that he pointed out. One is that it's durable. It's not going to, decompose or go away in any way. It's divisible. You could cut it up, or you could combine pieces of silver, coins of silver to make an amount, or you could split, divide those pieces up to get to closer to an amount that you need, for example, to pay for something. And the US, the original US dollar was actually worth 8 Spanish reales, which were known as pieces of 8. So the Spaniards, introduced that aspect to money, and the US took it on when the country was founded. Silver is convenient because it has value, and you can pay for a reasonable amount of things. Let's say with a smallish amount of silver. It's consistent. If it's pure silver, every single piece of silver is the same as every other piece of silver and has value. And that's something that distinguishes it for me a little bit, even more so than gold, is that because silver has we can talk about this a little bit later, but it has some big industrial implications. And so silver has intrinsic value. People want and need silver on a daily basis for all kinds of things. So these 5 main reasons that actually Aristotle had enumerated back then are still true today, and that's one of the reasons it has been money forever. Aristotle basically laid out these 5 main reasons why silver made for perfect money, or the best money, I should say, at least. I don't know about perfection, but it's interesting that this was when Aristotle enumerated these 5 points. This was around 300, 400 BC, when in fact, for probably 1,000 years earlier, silver had already become the first true international currency, and it was his own ancestors in Greece that had fashioned the first silver coins that eventually spread east to India and elsewhere. And were being used very commonly and were being accepted. That was the interesting thing, that silver coins were being accepted between, different nations, different people. And it was an easy thing for them to be able to trust in terms of value. Everyone came to recognize silver and silver coins at the time. And so, one of the things I say in the book is that money is the most important invention of all time. And when I say money, I mean something like silver, for example, that has value, retains value, and is a basis for storing value. And because we were able, as people, as a society, to find a way through silver to store value, to store effort and value into something that maintained its value, where you're able to have faith that we could produce something. And I don't mean silver, I mean, a farmer, for example, could produce eggs or produce wheat and sell that, store that value in silver, and then eventually turn around, you take that silver and buy something else that he or she really needed in exchange for that, rather than having to barter. So the facility of doing transactions, which was opened up through money, for example, like this, allowed a lot more commerce to take place. And as you allow commerce to take place, you allow, invention, and you allow progress to happen. And so that's one of the reasons that I feel that, the finding a solid, reliable, inflation protecting way of storing your efforts, which is what I believe money truly is. It's a store of your effort. Made progress truly speed up. And so I believe, money in this form was very important, and that helped us get there.
Absolutely. Peter, thanks for giving us a background there of the history. I always find it's important when you're looking to anything to always understand the history, because then that helps you understand what you're even investing in, right? Like the whole thesis and where things are today and all that stuff. And I thought you did a good job at explaining, in terms of the evolution there, where money kind of formed and how that, brought things to going from barter to then eventually, a form of trade in terms of what a money approach, right? To then
Exactly.
allow commerce. But something that I want to move to next is, now that we have the history, I know in part 2 of your book, you talk about why silver matters today. You actually explain like the central planners, past and present, have done to the money supply. Why does this story always end badly for investors who don't see it coming? And what are some strategies that central planners have used and continue to use to try and climb their way out of huge debt?
Okay, so I mean, central planners are basically central bankers and I guess sort of higher up government administrators. And the fact that we have no more gold or silver that backs our money, which we did. Silver was part of our coinage up until about the mid 60s, speaks to the advantage that central planners have when there's nothing of intrinsic value sort of anchoring the currency. That allows them to print and print like crazy. And they print because it allows them to fund projects or programs that are their pet projects, things that they want to advance for whatever reason. Sadly, it helps them to advance some projects that are often very destructive, like war, because war is not cheap. It needs to be paid for. But if you can print money to pay for it, then it allows you to go down that road. So what they've done is they've, in 1971, that's sort of like the big pivoting point, is when President Nixon in the US decided to close the gold window. And that meant that countries that held US dollars prior to that time could exchange their dollars for gold. The US dollar was exchangeable for gold by other nations, not by individuals. And he saw that was restricting the US's ability to print money. And with wars that had taken place, Vietnam, Korea, and trying to, advance lots of social programs in the prior decade, it was getting very restrictive. So by removing gold from the US dollar in terms of an anchor, it really allowed them to start printing like crazy. So that was sort of a first sort of firing pistol. And then it's no coincidence, certainly in my view, if you look at what happened in the 70s in terms of inflation and what happened with the gold price and the silver price, that took place at the very beginning of the 1970s. The money printing started to take off, inflation took off, and gold and silver exploded higher. So anyone who held a decent amount of silver from 1971 until 1980 actually did very well, despite the inflation that came on. Many people in a real sense, if they started with $100, were left with, I believe it's $33 at the end of that decade. But if you had silver, $1 became $38. So it's more than the complete opposite. And today, that's something that you brought up, how things are today, and what's happening today. And if we look at parallels, well, inflation is back in a big way. Money printing took off, especially after the great financial crisis in 2008, 2009. If you look at central bank balance sheets, they exploded. Prior to the financial crisis in the US, the Federal Reserve's balance sheet was about $1 billion. Over the next couple of years, it made it to 2 trillion. That was incredible that it would double in such a short time. And then it kept climbing and kept climbing and climbing over the next decade. And by the time we got to 2020, before the pandemic, we were at 4 trillion. And within about 18 months, it made it to 8 trillion. So we're now at 9 trillion. Whereas less than, 12, 13 years ago, 2008, we were at 1 trillion. So we're at 9 times where we were in the Federal Reserve's balance sheet it's just incredible what's taking place. And this is a story that repeats across the globe in most developed countries. And if you look at more recently at the pandemic and the stimulus that took place, the reaction and so on, some interesting statistics are that 25% of all the US dollars in circulation were put into circulation in the 18 months after the pandemic hit. So we're talking worldwide since US dollars exist. All US dollar, 25% of all US dollars, I'm repeating it, have been put into circulation since the pandemic hit. And in the last 20 years, the global money supply is up by 5 times what it was. So, these are all things that inevitably create incredible amounts of inflation. The Fed's been saying for years that, if anybody remembers, if you think back to prior to the pandemic, inflation was at 2% or less. It was what I call anemic. Europe, it was less, and they were all, concerned and struggling and doing everything they possibly could to try and get interest rates to go up, get people to spend, to get inflation to go up, to get people to spend. And one of the examples I give in the book is something called financial repression. And that's something that's deliberate, that governments do, and central banks, I guess, together work with the governments to accomplish, is that they purposely keep interest rates low while they know that inflation is present and potentially growing. And so what this does is, the governments, as we know, have huge debts, and the higher inflation is, the easier it makes repaying those debts for them over time. And so that's what they do, because they have to get themselves out of that corner. But in the meantime, what it does is the citizens who saved in that currency are suffering. They're losing out. Imagine a retired person that maybe has saved $500,000 or even $1 million in a couple of decades ago, was being paid, let's say, 4, 5, 6% a year on that money without taking undue risk. So even if inflation was low and they were losing 1% or so, or 2%, earning 6%, they were still making a net of $40,000. Today, they'll barely get maybe $10,000 on $1 million, 1% if they're lucky. And so that's the repression part. They're being made to pay for inflation that is sort of running rampant while interest rates are being kept purposely low. And they've managed their affairs properly, being savers, not spenders, and tried to plan for their retirement. And yet all of this is working against them. And it really makes things very challenging for them. One of the few options they have is to really start spending down their capital. They can't realistically expect to live from the gains on that capital. And that's where you find yourself in a scenario or an environment where you need to look at other things. And it's sad, but I feel that what all of this does is it pushes us to become speculators, really. And so as speculators, we need to look at what things can help protect us in this environment that will produce an attractive return, that are not overvalued, and that have shown themselves to perform. And silver certainly fits that bill. We can certainly talk about that a little bit more.
Absolutely. Yeah, Peter, I think you did a really good job at explaining, why silver matters today. You did an excellent job at talking about, inflation, how hot it is. And it's funny because, like back in 2020, like you said, it was around 2%. Now it's actually, I think, over 8.5% in Canada, I believe. In such a short period of time, inflation has just times 4, in such a short period of time, which is crazy, right? Yes. And I think it was already on the path of doing that, but I think just it got kind of, a little boost, with all the stimulus printing for the pandemic and now the war and other things that are going on. And to touch upon like your point that you brought about people are losing value in their wealth, You could clearly see it right now if you go to the grocery store. You could clearly see it if you even go, get gas. I drive a smart car, and I actually have premium gas that I always put into it. And I couldn't believe that I paid, $2.30 yesterday, to fill up not even a full tank. I was a little short, right? Because I'm realizing now that I have to put more money to full tank. But the point being said, why I'm bringing that up is this is more than ever such an important time, I think, for people to get educated, people to have a better idea of investing their wealth rather than speculating, or if you speculate a small portion, obviously, right? So I think you did a really good job at explaining that. And something that I want to move to now is, I know in part 3 of your book, you talk about that silver is irreplaceable metal. You discuss why silver is unique, both not just monetary, but also industrial, which briefly touched on. But silver is playing a huge role right now in solar panels, electronics, just like what we're using right now to communicate, a computer, our phones, telecommunications, medicine, and electric vehicles, right? Everyone knows about, the famous Elon Musk, coming up with Tesla, and now all of these other cars, fall in his kind of lead. And in fact, the government has launched massive infrastructure spending programs that favor green economy. So all of this being said, how will this continue to raise silver demand and provide the rare opportunity for investors to make huge gains from silver investments?
Yeah, so thanks for bringing that up, because that certainly is important and a big part of why silver is so interesting today. And more than half, it's about 55% of silver demand actually is from the industrial side versus the investment side. So people will buy silver to just hold as an investment, waiting for the price to go up. And more than half of silver is actually bought to make things and to go into things. And so, like you mentioned, solar panels, electronics, medicine, electric vehicles. I'll give one example, which is solar panels. More than, I think it's over 11% of silver demand goes to one single use, and that is solar panels. So if you figure the annual supply of silver is 1 billion ounces, more than 100 million ounces every year goes just to solar panels. And solar panels are the cheapest form of renewable energy. As we know, we're trying to move towards a greener economy, and a lot of governments are being very, supportive of going in that direction. And so they're supporting trying to produce energy in ways that are renewable, that are low carbon. Solar certainly fits that, one, because it's carbon free, and because it's the cheapest form of renewable energy. And so because that form of energy is being pushed so much, and it's the single largest consumer of silver of any kind, to me, that bodes very well for silver. Now, I have not even accounted for other applications, things like electronics. It's everything. You just look around you and you don't even realize, but your smartphone, your tablet, your laptop, your computer screen, your computer. I mean, it's really everywhere. And so that's another application to telecommunications as well. Things like the 5G rollout for cell phones. It's in medicine because it's a biocide. And so you find it in all sorts of applications there. It's in equipment. It's on things like, let's say, knobs and things that you may handle because it will kill bacteria. And by the way, the bacteria that it kills do not learn, I guess you could call it, and change from the effects of silver. They don't get smart, so to speak, against silver, and so silver remains effective against those bacteria. And then electric vehicles certainly is one other one that we mentioned. So with all this massive push towards decarbonization and towards green energy, and again, solar again being the big outstanding, I guess, example of a silver application, I feel that There's so much sustained demand of silver use on the industrial side that will help to keep a rising floor under silver prices. It will not be necessarily the factor that will drive silver dramatically higher, but it will provide a very strong floor under silver prices, that demand being so consistent. So I don't feel that silver prices could fall off by much for long because of the industrial side of silver demand.
Awesome, Peter. Yeah, thanks for expanding on that and sharing that specific example, with solar panels. Something that, I'm thinking about is, I know in part 4 of your book, you talk about silver as a unique set to soar. You explain that there are distinct factors to drive silver and silver investments. And something that I know we spoke about before we got into the Zoom call, just 1/10 of the size of the gold market is silver, right? So it takes much less buying pressure to send silver prices sky high. So to give my listeners confidence in your prediction, what is one way we can arrive at the same peak target price for silver?
So, there is certainly a close, I can give a couple actually, if you'd like, but
sure.
One of the things that we always look at, gold being sort of the king of precious metals, is gold and what gold is doing and the relationship between gold and silver. And so if you look at the price of gold versus the price of silver, you can divide the two. You can divide gold by the silver price, gold price by the silver price, and it gives you the gold silver ratio. And currently that price or that ratio is about 80 times. And if you can follow that over time, it's just, a chart, and you can find these charts easily. That ratio, if you go back about 4 or 5 decades, has averaged about 55 to 60. So to say that over the last 50 or 60 years, it's taken about 55 ounces of silver to buy 1 ounce of gold. Today, it takes 80 ounces of silver. So on that basis, silver is cheap versus gold. You need a lot more silver ounces than you normally do on average to buy 1 ounce of gold. So gold is relatively expensive to silver that is relatively cheap versus gold. So if you look back at what happened at the 70s, and as we spoke earlier, that's our best analog for where we may be in this time for gold and silver, for example. The ratio of gold to silver bottomed in 1980 at 15. So that meant it took 15 ounces of silver to buy 1 ounce of gold. That is an all-time low, meaning that silver had become overpriced or very expensive relative to gold, because the ratio was, is closer to, say, 50 or 60. So because it took so few ounces of silver to buy 1 ounce of gold at that point in time, that was a big indicator at the time that silver was peaking, that if you took your silver and were to exchange it for gold at that point in time, you were getting a lot of gold versus the amount of silver you had to use to pay for that gold. So a bottom of 15 ounces of silver to 1 ounce of gold is something that we can look back at and compare and see where we stand now. So multiple times, this ratio has peaked at 80, and that's an indicator that we may be at a point where the ratio starts to fall. That's been the case historically. When the ratio peaks at 80, silver is cheap versus gold, and the ratio is likely to start falling, meaning silver is likely to start gaining against gold, meaning the silver price is likely to start rising faster than the gold price. So right now, at the ratio being around 80, that certainly suggests strongly to me that silver is quite undervalued versus gold, and that it's likely to start rising against gold. So that's certainly something that's compelling. In 2011, that ratio bottomed, had a clear bottom again at 30, meaning it took 30 ounces of silver to buy 1 ounce of gold. And that was a peak, at least a mid-bull, as far as I'm concerned, a bit of a mid-bull peak in the silver price. It reached $49. It didn't stay there for long. But if you use that ratio and saw that, wow, this is an outlier, silver is usually not this expensive versus gold, it may be time to take some profits in silver. And that's how it ended up playing out. The ratio rose quickly after that and has stayed higher and has bounced around. But we're right now, as I say, at 80, and I believe it's going to start falling again soon. And silver is going to start gaining on gold. So that's certainly one way to look at that. Something, I know this is a little bit of a longish answer, but it's something that I think is worth noting. And in the book, I talk about different ways that I get to one of my target prices. For me, that's $300.
How do you come up with the number 300?
My target for silver ultimately is for it to reach about $300. And in the book, I give multiple ways that I arrive at that target. And it's not some sort of a magic number or whatever, but what I found interesting is that in my research, it ended up being the number that I got to in multiple ways. And for me, that became significant. I thought, wow, that's interesting. If I look at ways that I could find an ultimate peak in the silver price, and they're basically all pointing me to $300. At least for me, that says something. That's certainly the number that I feel is some sort of a realistic target. And we talked about the gold silver ratio, so let's use that as an example. I feel, and in the book, I give multiple examples of people who are very well read and researched on gold. And they feel that gold will reach anywhere from $5,000 to $10,000 as a peak price. Potentially, it'll go further. But I have even said publicly, going back to about 2009 or 2010, that I think gold will at least reach $5,000. And that's really only 2.5 times from close to its current level. If you take $2,000 where it's been at twice already, so it was there back in early March when about a week or two after Russia invaded Ukraine, it peaked at $2,000. It was there in August of 2020, post-pandemic panic, I should say. So that's 2.5 times $2,000 to reach $5,000. So if we use the gold silver ratio where the ratio bottomed at 15. If you divide 5,000 by 15, that gives you $333 silver. So I feel $300 is realistic. That's close to 300. If you use another higher target for gold, which, as I say, I feel is also very achievable, and as I say, give multiple examples in the book. I feel very smart people think 10,000, and they have their different ways, actually, by the way of reaching that predicted price target of 10,000. If you take 10,000, you divide it by the gold silver ratio of 30, which is where it bottomed in 2011. So 10,000 divided by 30 gives you $333 silver. Again, close to 300. And for me, certainly, again, a realistic way of finding a peak price for silver. So yeah, I mean, multiple ways to get there. There are more in the book, but these are two good examples, I think.
Awesome. Thanks, Peter. Thanks for sharing, those two specific examples of, how someone could, just better understand, silver's power. And also, more importantly, sharing with us the value prediction that silver could reach 300 and how it's not just a random number that you pulled out of the hat, but how there's actually different ways that get you there. And it was interesting to hear about the gold and silver ratio, because I think especially listeners right now who are listening, who are kind of new to this space or kind of learning about it, I think that is a really good way for them to understand this whole compelling opportunity that silver has not really made its move yet, and that it's still very undervalued. I think my next thing that I want to lead to is your last part of the book. You talk about, investing in silver and the ultimate guide. You write about the different silver investment options available, whether that's going from physical coins and bars all the way to the junior exploration stocks, right? So that being said, what is the ideal way to build a silver investment portfolio? And correct me if I'm wrong. I think you have something called MAP. It's like the MAP approach.
That's
So
right.
could you expand on that?
Sure. So, I mean, that's something that's very simple. And I just kind of eventually developed because I thought it's an easy way for people to remember how to approach investing in silver. So what I call a silver map system is where you have silver is for this physical silver aspect that, I think it's wise to own a little bit of physical silver. You have that sort of lowest risk tangible asset, not ever going away, and that you are able to control, and has proven itself over millennia as maintaining its value. And then the map part of the silver map system. So the M is for miners, so that people can build a silver portfolio by allocating some of their capital to silver miners. The A in the map is to allocating, so to not just buy miners, but to spread your investments over the physical silver, some miners in different categories and different risk levels. And then the P in the map is to take profits, to lock in the gains that you've produced. And especially if you're looking at some of the junior mining companies or junior explorers that tend to be riskier and more volatile, you definitely want to lock in some profits at different points so that you can benefit from the gains that you have, and you can perhaps further diversify, take those gains and buy other stocks, silver mining stocks that you've been watching, or simply sit on the gains if you'd like. Take them and put them into physical silver again, if you'd like. You can look at your portfolio, and wherever you feel that you perhaps are underinvested, or you have, the most confidence, or where you feel that portion of the portfolio is perhaps offering the best value, you can take those gains and reallocate them there. So that's the silver map system that I suggest. And then the portfolio itself, I come up with what I feel, at least for me, is an ideal silver portfolio. And I don't mean, by any means that everyone should take all of their investable funds and put them all into silver investments. What I'm saying is that take a portion of your funds, of your investable funds, decide what portion you'd want to allocate to silver investments. And then the way I would break down that overall silver portfolio is I would have 10% allocated to physical silver. I would have 50% allocated to the lower risk silver stocks. And that includes things like silver ETFs, which is like a stock that's instantly diversified across a number of silver miners. And that same 50% part of that same 50% could also go to large silver producers and even silver royalty companies, which don't actually mine silver, but receive a portion of silver that's being mined from companies that they've invested in. And then from there, I suggest 20% can go to growing producers, the sort of mid-sized silver companies. And then another 20% could go to junior silver explorers, who most times are the highest risk, highest volatility companies. But obviously that's where you can get your 10 times gains or 50 or 100 times gains. I've seen it before. It happens. You don't want to over allocate to that sector. And that's why I say, a maximum of 20%, and to spread that amount across at least 5 different stocks. And that's a way to build a portfolio that's reasonably diversified.
Awesome, Peter. Yeah, I'm glad that you shared that blueprint of how, an investor could allocate their money and how they could diversify. Because sometimes a lot of people don't realize that even within the mining sector, there's different ways that you can allocate. So I really appreciate that response. And something that I want to move to is, I know that you and I both know that investing in the junior mining space involves a huge amount of risk. But when you invest in the best ones, as you kind of mentioned, the gains could be massive. What are the 5 secrets to managing risk?
The first is going to be how you allocate. So you, as I say, this is something we've heard many times before, but you spread your risk. You don't put it all into, let's say one silver stock. You want to spread it out. And that's why I say, at least in the junior portion of the portfolio, you want to be at least in 5 names, 5 different stocks, and I suggest even up to 10, ideally, really, if you have the capital to allocate across those. From there, what you can do is you can buy into your positions in a I guess a disciplined way is what I would call it. People tend to find something that they find interesting. They do their research and then they say, okay, well, I have $1,000, I have $2,000 that I want to put into this stock. And then they just go and buy it. And I think that that's a mistake. A lot of times, especially in more volatile stocks, it makes sense to, one, obviously watch that stock, see what the price is doing, see what it has been doing recently. And over, let's say, the past year or couple of years, where does it look? If you look at a chart of the price, where does it look based on recent past? And then you could say, okay, well, I have, if it's $1,500, I'm going to allocate $500 to it now. The interesting thing with that is that you've actually made a commitment. It forces you to watch it. It makes you more implicated in that investment. And then you can watch it over time. And if you see that it starts to back off, if the price starts to come down a little bit, if you see that it starts to perhaps bottom and starts to rise slightly again, then you could say, oh, well, you know what, here's a chance for me to buy a little bit more at a little bit lower price and add another $500, and that's maybe 2/3 of my position, and then to keep watching. And then at some point again in the next sort of weeks or months, you might decide, okay, it's a good time for the last portion. So if you spread out your investments into a new stock over time, that certainly helps to mitigate risk. It takes away the chance that you're buying into it all at once and that the price should drop suddenly. If the price should drop suddenly afterwards and you haven't fully committed, then you have some funds you could use and you say, is there anything fundamental that's happened with the stock? And if nothing fundamental has happened and it's just a better value, then you say, oh, well, okay, let me allocate more funds to it, and actually gets you a better price. Another approach to mitigating risk is to do what I call playing with the house's money. And that's where you, especially if you get a double in your stock, so if you pay $1 for a share and then a year later, the stock is trading at $2, you may want to say, okay, I'm lucky here. I've doubled my money. I'm going to sell half of my investment, keep the other half invested. And so essentially, you're staying invested at no risk and at no cost because you've taken your full original investment back out, and you can take those funds, either allocate them to another investment that you've been watching, or simply bank it, as I say, or look for other things that you've perhaps been keeping an eye on. There's something called trailing stops, which is where once you've allocated or you've made an investment, a specific investment, then what you can do is you watch what happens with the stock price, and you give yourself, I guess, a margin of a certain percentage. People will often use 25%. It doesn't have to be that number. That's a little bit random, but not too big either, I suppose, in terms of percentages. You wouldn't want to go too high. But once you've invested and you assuming the price rises, continues to rise, et cetera, over time, and you say to yourself, okay, this has done well for me. I don't want to lose what I've earned in this. I'm going to place a trailing stop. So if you've chosen 25% as your trailing stop, I'll give an example. You spend $4,000 on an investment. After a couple of years, it's risen rather steadily, and you have your trailing stop in place, and you reach $8,000, it's doubled. And you say, okay, this is pretty good. I'm prepared to sell my holdings in this company because I have some pretty good gains. I don't know if it's going to continue going higher. It could go higher, it could go lower at this point, but I really don't want to not benefit from those gains. So from that point, should the stock fall consistently by up to 25% on a what I use is the closing price, so the last price of a given trading day, then the next day you would sell. Quite simply, no questions asked. You just go and you sell that position. You take your profits and your original investment, and then you may allocate again to something else. So trailing stops are pretty useful. They help you to protect profits. They could also help you protect profits or capital, even if your holdings were to go down. You could put $4,000 into something one day, and because your timing is not good, and it consistently starts to fall from that point and goes over the next maybe 6 months steadily down to $3,000. So that's 25% below your original $4,000. You might say, okay, I have my 25% trailing stop in place. I'm going to sell. I don't like taking the loss, but it's 1,000 out of 4,000. I'm going to preserve my capital at least, because obviously it could keep falling further. So you say, I'm going to sell, preserve my capital, take that 3,000, and then look for something else that I can allocate to that, again, is hopefully undervalued and could provide me some attractive returns. There's also rebalancing, where let's say periodically every 6 months or every year, you look at your holdings and you may decide, okay, some of these have really moved up tremendously or markedly at least, and you'd say, all right, I'm going to sell the gains from those stocks. I'm going to take them and I'm going to either allocate to some of the other stocks I have that have gone down, that I still like, that have underperformed because I feel that they're even better values now, or I will take those gains and I will simply allocate them to a new holding, something that you've been watching that you find attractive and that you now have some capital that you can allocate to. And so, yeah, these are multiple ways that you can manage your portfolio, deal with some of the volatility, and lessen your risk.
Awesome, Peter. Yeah, thanks for sharing those secrets, to manage risk. How can a retail investor foster a contrarian mindset and know more about silver than 99.9% of investors?
Contrarian mindset, that is not easy. That's something that I think that you certainly develop over time, being involved. I mean, it takes time. It's effort. It's following these things, and I think it's also seeing and living through some of these cycles, because it's one thing to read about them. It's another thing to actually live them and experience them with your own money at risk. And when you see the cycles and you see that, yes, you can have these tremendous run-ups, and yes, it will come back, and it'll give up many times a large portion of those gains. It's not easy to be a contrarian, but many people who are listening they follow investing, especially in resources, have probably heard Rick Rule say something along the lines of, you're either a contrarian or you're a victim. And that is so true, because the victim is the one who follows the herd and buys things that are overpriced. And they become very quickly victims, because those overpriced things tend to become underpriced very quickly. So the contrarian does the opposite. The contrarian buys things that are underpriced. And that means buying things that are hated. That's being contrarian. And it's not easy, because it's not popular. So as an investor, honestly, if you want to make money, don't go with what is popular, unless it's not impossible, but you can do what they call, I guess, momentum investing, where you're sort of following trends. But those trends tend to change very quickly. And so that's where you really, really would need something like trailing stops, and they would have to be very tight trailing stops. But the contrarian looks for things that are undervalued. And so because they're paying less than the true value for that investment, their risk is lower because the downside is lower. But they have to exercise patience at that point. But those tend to be much, much bigger payoffs. And the beauty of it is that if you know that you've bought something that's relatively undervalued, you feel more at ease, perhaps more confident that your downside is limited. And your upside is tremendous because you've paid so little. It's like going to, the grocery store and buying something that's non-perishable that's at 90% off. Well, if it's not expired and it's not perishable, why wouldn't you load up on something that you always buy that is at a dramatic discount? It's not going to go bad. You're going to use it. It's one of your favorite things. And in a short time or at some point in the future, because you can't keep producing something or selling something at a 90% discount, it's going to have to return to its full value. And that's what the contrarian does. It buys things really cheap and exercises patience, waiting for the rest of the market to come to the realization that it is cheap and it needs to be revalued at some point. And that's where you're likely to do very well, as the rest of the market discovers what you knew much earlier. And how you can do that and know more than 99.9% of silver investors? Well, I'm certainly biased, but the book will do that for you. I say so in the book. And because there is just so much information about silver, its history, its background, its potential, what makes the entire silver market tick, I very confidently and honestly believe that if someone has read this book, they really will, because it's such a small market and not something that people follow so typically. If you've read all of this, you will, I truly believe you will know more than 99% of investors about silver and silver investments.
Thanks, Peter, for giving us more awareness there about the whole contrarian mindset, especially if a listener doesn't have that much knowledge or kind of background on it. I definitely agree with, those wise words from Rick Rule of you're a contrarian or you're a victim. And definitely it is important, kind of goes with something that I was saying earlier on, is you want to try and beat the herd, right? You want to actually be in the room first, right? And then let the party join you so you could then take your profits, right? And do well as an investor. So I think you did a really good job at highlighting that. And I also do think in terms of a place, kind of like how you mentioned your book, I actually agree, because I've been able to take a look at like the manuscript. So I thank you for that. And I've been able to see that it's not just a book where there's 4 or 5 chapters and a lot of it is like repetitive information. I found you did a good job at highlighting, okay, yes, the mainstream information of silver, but then you hyper focus on some aspects that not everyone knows about. And I believe there's 54 chapters, right, in your book?
That's right. Now, I don't want to scare anyone away because 54 chapters is a lot, but the vast majority of those chapters are very short. And I've done that intentionally. I think that I felt like these were all sort of micro topics on silver, and that they were best sort of treated individually, and that, people having read each of them got that topic, understood it, and it was a concept that they could wrap their heads around pretty easily, because I treated it separately. And so it also has been written in a way that I hope is an easy read. I try, some places it does get a little bit more technical. There are really no ways around that when it comes to some aspects of investing, but the vast majority of the book is meant to be an easy read. Some of it is a little bit story-like, and hopefully, people will become engaged with it in that way. I'd like to just sort of jump back a little bit, if you don't mind. Something that came to mind, we talked about, the contrarian and the victim, and by being early in silver, the benefit is that, and we have the beauty is that we have a roadmap to look back at. We have the 1970s as the first, as the most recent full cycle silver bull market. And what happened was, we saw these tremendous gains in silver, but what tends to happen is that gold gets most of the attention and most of the focus. And so the bull market that happens, concurrently, usually with silver in gold, is pretty good as well. Perhaps not as ultimately performing, but still fantastic returns. But gold gets most of the attention, and people will look to buy gold. But what happens is many people, as we mentioned, tend to be late to the party, and they pay attention. They notice the gains in something as they've progressed, and have really, most of the gains have already come, basically, is what I'm saying. And that will be the case in gold. And so they'll look at gold and they'll say, oh, okay, well, gold's now at $3,000, or it's now at $4,000. I really need to, I'm going to miss this boat. I need to get in. And they say, well, if it's at 3,000 and it was at 1,500 a couple of years ago, that's kind of expensive. How else can I participate in this? And often silver will be the beneficiary of that. People will look for an alternative. Silver is, gold's sort of cheaper cousin. And they'll see that they've often moved together. And by the way, silver always outperforms gold in bull markets. That's something that the research has shown. And so they'll turn to silver, and they'll start bidding up silver, and they will flock to silver. And that's something that we have seen repeatedly. And that's why, if you are the contrarian and you're relatively early in the market, it's all these other buyers and all these other participants who come in after you that help you achieve those gains, because they're buying and buying and buying and pushing the price up. And because you were there earlier, you're benefiting from it. But the only way to get those benefits is by being there. And yes, you may have to wait a while. Odds are you will have to wait a while. But your risk of downside at this point are so low, because silver is so undervalued historically. And the book explains all of that, in fact, in multiple ways, why silver is so cheap. Your downside risk is so low that your opportunity cost is next to nothing in terms of investing in silver. The upside's tremendous, and by being relatively early, all these other investors that eventually come to silver will help you by buying later to push the silver price up and achieve these gains. So sorry I jumped back to that, but I thought it was really an important point for people to realize.
I think it was a good call on touching on that point, Peter. Again, it just brings another supporting reason of why it's a great opportunity right now for listeners thinking about investing in silver, or if they're already in it, adding to that conviction to stay invested in silver. So no, I appreciate that. So Peter, something that I want to move to now, I've been asking a lot of my guests now, what is their definition of greatness? And the reason is because, I'm really looking to inspire millions of people to achieve greatness and enhance their overall personal well-being. So what is your definition of greatness?
I would say that it's someone who has found something or some things. It's hard to do this for more than one thing, I would say, but you can do it in different aspects of your life. But to do the best to do and be the best at that or those things. I mean, really be really good at something. And there are different aspects to that. It's not just being the smartest, but if you're someone who's an academic, for example, being great at what you're doing has multiple facets. It's not just being a great researcher, for example. If your research, if no one knows about your research, then you're not really doing much. You're not having an impact. You're not achieving enough. So there are other aspects, and those other aspects may be the communication of the research. So look at what it is that you really like, that really is meaningful to you, that you feel has an impact for yourself, your own life, of course, but that can be often, if you're doing things that have a great impact for yourself, that will impact others around you. And it doesn't have to be huge numbers of people. It could be in your immediate family or your immediate circle. But if you're trying to be the best at at whatever is important to you. And again, that hopefully is in multiple things in your life. But if it's, I guess, in a work sense, if you're doing the best that you can at what you're doing, look at the different facets of that, look at the implications, and look at how if you're doing enough to be good at those different facets of it, it'll help to achieve sort of the overall goal. And so, yeah, I believe that that's a definition, at least in my mind, of greatness.
Awesome, Peter. Thanks for sharing that definition. What I got from that is do the best that you can, love what you do, and share your gift with others. And Peter, something that I want to move to is, who is a future guest that you would like to see on this show?
Can I name two?
Go for it. Yeah.
So, I mean, we mentioned Rick Rule earlier. That is someone that I think that is very passionate about helping to educate people about investments, and certainly understands multiple facets of investing, resources, of course, in particular, but has told me in interviews that I've done with him about his outsized gains in silver. And I think that's a tremendous thing to learn about. He's actually said that silver has contributed outsized returns versus other resources, for example, or other investments to his overall wealth. And he's, from my understanding, he's quite a wealthy person, has accomplished a fair bit on that side. So that's certainly somebody that you want to listen to. The other person that I think is well versed in this field. I mean, I'm again biased towards silver, but someone who does a lot of research as well, knows and understands a lot of the economic background and the technical side of investing and the benefits of silver would be Tavi Costa, who is with Crescat Capital. And I think that he would make for a great guest. People certainly follow his work and realize that he has a lot of interesting things to say about this market and this sector.
That's awesome, Peter. Thanks for sharing, those two recommendations. I have some good news for you. We did have Tavi Costa on last year, so I've already met that need, but it would be good to have him back on because he's done a lot of great work. So I definitely look forward to having an update with Tavi. And then in terms of Rick Rule, you're not the only one. There's been, I think, 4 or 5 guests on my show that have actually mentioned his name. Sure. So I am working hard to get Rick Rule on the show, and I hope to have him on pretty soon. So when that happens, I will definitely let you know, as well as the other previous guests who asked if he could come on. And Peter, just to end off today's podcast, where can my listeners go to connect with your work online?
Okay, so that's easy. The book is available on Amazon. It's been a week so far, and as we mentioned at the beginning, it's been a bestseller in commodities in Canada since almost the day that it launched. So I'm really happy about that. I think people are enjoying it and realizing what it has to contribute to understanding silver and investing in this space. So you can go to Amazon, just type in The Great Silver Bull. It should bring you right there. And you can go to know of any sort of updates and so on, developments about me and the book. You can go to thegreatsilverbull.com. That's I guess a website that I have that's dedicated to the book. And my newsletter, you can find more information about at silverstockinvestor.com. Everything on my background and the details of that letter, how it works, and what our goals are with that also. So these are multiple ways that you can follow me. Awesome. I'm also on, forget, I'm also on Twitter and on LinkedIn, and on Twitter, it's at Peter_Krauth. and LinkedIn, Peter Krauth, and you should have no trouble finding me, and be happy to connect with everyone.
Awesome, Peter. So I will be sure to put all that information into the podcast notes. That way it'll be easy click for my listeners to just click and directly, go to your website as well as your other social media platforms. And Peter, I just want to end off today to thank you again for being here. Thank you for making the time for the show. And thank you for sharing all of your wisdom as well as passion about the silver market.
Well, Ben, thank you so much for having me. It's always fun. I'm thrilled to have somebody like you who appreciates the benefits and wants to understand more and wants to help share the information more. I really think that, it's not an accident that I called the book The Great Silver Bull, and that I say in there that it's a generational opportunity. And, the subtitle is Crush Inflation and Profit as the Dollar Dies. And that was something that I also did quite deliberately and intentionally. Inflation is a dramatic, is a big problem, I think, today, not going away. And so, I really want people to realize that and what tools are available to them to help protect their financial futures. And, you having me on and others who are passionate about something in investing, I think is also a great testament to how you're living your greatness, and you're helping people to really, make their lives really as good as they possibly can. And so thank you for that. I really appreciate it.
No problem, Peter. No, it's my pleasure to support, I think, anyone that I think is doing great work right now. And I know in the last couple of years, it's really had an impact on my life financially. So I'm trying to pass on the torch. So this is one of my ways of doing it, is through a podcast, right? And through bringing on these people who I feel have impacted me. And I think more people deserve to know about it. So no problem at all. So thanks again for being here today.
I appreciate it, and be glad to be back anytime.
Awesome. Sounds good, Peter. Thank you for listening to the Living Your Greatness podcast. If this show has added value, please subscribe, leave a rating, and make a review. This podcast is for informational purposes only and is not to be considered personal, legal, or investment advice or a recommendation to buy or sell securities or any other product. It is based on opinions, current events, press releases, and interviews, but is not infallible. It may contain errors, and Living Your Greatness offers no inferred or explicit warranty as to the accuracy of the information presented. If personal advice is needed, consult a qualified legal, tax, or investment professional. Do not base any investment decision on the information contained on Living Your Greatness or our videos.